Welcome to The Explainer. Today, we are pulling back the curtain on the secret financial life of your assets. We're going to uncover a single, powerful number that tracks everything from your house to your stocks. And yeah, this number could literally save you a fortune in taxes.
So picture this. You just sold your house, you did great, walked away with a cool $200,000 profit. Amazing, right? But then the tax man comes knocking. And the big question is, how much of that do you actually get to keep? The answer, well, it might not be what you think.
It turns out the key to that six-figure question isn't buried in some ridiculously complicated tax form. Nope. It all comes down to one single, powerful number that has been tracking the entire financial story of that house since the day you bought it. And that number is called your basis. Honestly, this one little word is the anchor for pretty much every tax calculation you will ever make on an asset. Understanding this, it's like having a financial superpower.
So what is it really? Simply put, your basis is what the IRS sees as your total investment. It's the starting line for measuring your actual profit. And if you remember one thing, remember this. The higher your basis, the lower your taxable gain. That's the name of the game.
To really get this, we've got to go right back to the beginning. Let's look at how an asset's basis is born, that moment you acquire it. This is your starting point, and it is absolutely crucial. And here's a pro tip. Your initial basis isn't just the price you paid. The IRS actually lets you roll in a whole bunch of other costs. You know, things like legal fees, recording costs, even some of the taxes you paid at closing. Every single one of these things increases your basis, which is exactly what you want, because it's going to lower your future tax bill. But, the story doesn't stop there. An asset's basis is not set in stone. Think of it more like a living number that actually evolves and changes over the years that you own the asset. Okay, and this brings us to something that trips a lot of people up, the difference between an improvement and a repair. A capital improvement, like putting in a whole new HVAC system or adding a room, that actually increases your basis. Why? Because you're adding real value to your investment. But a simple repair, like fixing a leaky faucet, well, that's just a deductible expense. The big takeaway here is that improvements build your basis, and that can save you serious tax money down the road. Now, on the flip side, if you have a business or a rental property, the biggest thing that decreases your basis is depreciation. It accounts for all the wear and tear. But here's the trap, and it's a big one. The IRS says you have to reduce your basis by the depreciation you were allowed to take, even if you forgot to actually claim it on your taxes. So you miss out on the tax break and you still have to lower your basis. It's a truly painful mistake. All right, so this brings us to the end of the asset's life. The disposition, the end game. This is where all that careful tracking of your basis really pays off, especially when it comes to passing on your wealth. And that brings us to what a lot of people call the single most powerful tool for multi-generational wealth in the entire tax code, the step up in basis. Seriously, this is a total game changer. Let me show you what I mean. Here's a classic example. Let's say your parents bought a property decades ago for $100,000. That was their original basis. Over the years, it appreciated like crazy. By the time they pass away and you inherit it, that property is now worth $700,000. That's a massive $600,000 gain just sitting there. But here is where the magic happens. Because you inherited it, your basis gets stepped up to the fair market value on the date of death. So your new basis is now $700,000. So what does that mean? It means if you turn right around and sell that property for its market value, your taxable gain is zero, zilch. That entire $600,000 of appreciation, poof, it's completely wiped away for tax purposes. It's an absolutely incredible advantage. Now, don't confuse this with getting an asset as a gift. That's a totally different ballgame. When you get a gift, you also get the giver's original basis. It's called a carryover basis. And that means if you sell it, you're on the hook for the tax on all that appreciation. The tax code also has this clever little rule that stops people from just giving away their losing investments so someone else can claim the tax loss. So, those principles are the bedrock. Now let's apply them to the world of modern investing, because there are some specific rules for stocks and crypto that you absolutely need to know. First up is the wash sale rule. This is basically designed to stop investors from selling a stock for a quick tax loss, only to buy it right back again. If you buy a substantially identical security, which could be shares of the same company or even certain options, within this 61-day window, the IRS says, nope, you can't claim that loss for now. But, and this is the key detail, that loss isn't just gone forever. Think of it as being deferred. The amount of the loss that was disallowed gets added to the basis of your new shares. So, it increases your investment cost, which means you get to use that tax benefit later on when you eventually sell the new position.
And for all you crypto investors out there, listen up. Big changes are coming. Starting in 2025, the IRS is making you track your basis on a per wallet, per asset basis to bring it in line with how stocks work. You can't just average your costs anymore. So to get ready, you need a plan. Step 1, inventory your assets. Step 2, reconcile your cost basis. Step 3, allocate that basis to specific units. And finally, Step 4, document everything before you make a single trade in 2020.
You see, at the end of the day, managing your basis isn't just some tedious bookkeeping chore. It's a core financial strategy. It is the disciplined act of tracking your true investment so you can protect your capital and preserve your wealth from taxes you don't need to pay. And that leaves us with one final thought. We are heading towards a major shift in 2026 when a lot of the current tax laws are scheduled to expire. So the question is, now that you know what you know about basis, how to build it, how to track it, and when to use it, how are you going to strategically position your assets for the changes that are coming?